Hey everyone, my name is Rishi Kumar and I cover international and domestic financials, and today I'll be pitching you on Root Insurance. So Root is a direct-to-consumer insurtech company, and what they do is that they specialize in giving people auto insurance by using telematics technology, which is essentially where, instead of looking at the kind of car you drive and your credit history, they'll actually look at the way you drive and your behavior in order to give you a fair policy rate. And the insurtech space is projected to grow at a CAGR of 49% through 2028. So Root is in an industry that's growing very rapidly, and they have a best-in-class product that is extremely disruptive. So they're poised to really capitalize on this trend here. And Root operates within three main revenue segments. The first one is net premiums earned from their policies, which accounts for 90% of their revenues in 2020. Net investment income, which accounted for 1.6%, and other fees, which accounted for about 5.4%. The company itself is headquartered in Cleveland, Ohio, and their CEO is Alex Tim. So my drives for Root were as follows. The first one was favorable industry dynamics. So the entire financial industry's landscape has been really shifting for the past 10 years or so, and insurance has been no different. What we're seeing is that consumers are really changing the way they want to do insurance, and Root really addresses that. So most insurance companies, they really underwrite these policies based on factors like what car you own, what's your credit score. Root doesn't do that. Root looks at over 1,000 factors based on your actual driving behavior, and this is called usage-based insurance, and this space is growing very high. I mentioned how insurtech is growing at a CAGR of 49% through 2028. UBI is growing a little just as fast at around 30%ish, a CAGR of 30%. And historically, Root has been having extremely high revenue growth. So in 2019, they experienced about 500% revenue growth as a whole. And in 2020, despite COVID being an extremely high headwind, they're still able to post a 27% increase in revenues. My second driver was the expense ratio dramatization. So the typical expense ratio or loss ratio for insurance companies, it comes around 60 to 70%. And Root was extremely high in comparison to this. So in 2019, I believe they're over 100%, and in 2020 they're at about 78%. So they're still well high above the industry average. But keep in mind, this is a proprietary technology, and it uses a lot of data for what it does. So the more data it gets, and they're constantly getting more data because they're getting more users and whatnot, and more driving data, they're able to become more accurate. And it should also be noted that a lot of these insurance companies are able to get these lower expense ratios because they have a lot of renewals, a lot of repeat customers coming in over and getting policies. Root's essentially getting new policyholders because the other players are more mature, and Root's still in its growth stage, so it should be expected that their expense ratio is a little higher. And management has stated that they expect it to be in the low 70s very soon, and it could be. And I have in my model I had going much lower into the 60s as well. My final driver was proprietary technology. So Root has a sizable moat. So at the time Root started doing this mobile telematics technology, people actually thought that it was impossible to do what Root was doing right now. And players like Progressive and Allstate just didn't want to get their hands dirty with it. And if you look at their telematics technology, it's actually very basic. They kind of just look at your driving speed, which isn't really indicative of much. And what we're seeing is that as Root was able to get into the mobile telematics space, the other insurance companies decided to just outsource their data. So their data is not nearly as accurate, and they just can't do what Root's doing anymore because they don't have this sizable data that Root has. And if they were, their expense ratios also start going through the roof. So these matured insurance companies really can't replicate what Root's doing. So there are risks to this company, obviously. So the first one is financing needs. So this is not a profitable company. In my model, I had them become profitable in about 2027. Most people have it being profitable in 2026, but I decided to be a little more conservative relative to what the street was doing. So with this being the case, I want the risk comes is that they may need to get additional financing through debt or equity, through the capital markets, in order to raise the capital they need to stay afloat and really be able to grow at the rate they want to grow at. And the second risk I have is regulation. So Root uses a lot of customer data, and it could be in contempt with regulations regarding privacy. So if the Biden administration or state governments decide to say, oh look, Root's technology is a little too invasive, which I don't believe it is right now. They just look at it to give you fair policy rates. But regardless, if this were to happen, Root could be in a little bit of trouble. And my third and final risk is the inability to scale. So Root relies a lot on marketing expenses to grow their business and really ramp up their sales, as well as being able to scale their platform and technology itself in order to get lower expense ratios. So if they're unable to do that, the company could be in trouble, and it could affect them heavily in the long term. So in order to reach a final intrinsic value for Root, I constructed a 10-year DCF, and I used a terminal growth rate of 1.5% and a WACC of 8.61%. And I was able to get an intrinsic value of $14.18. And I did a sensitivity on a terminal growth rate and WACC of about 50% of 50 basis points, and I got a range of $13.91 to $14.86. And additionally, I also constructed a Black-Scholes model, and I reached an upside intrinsic value of $15.47 and a downside intrinsic value of around $8.16. And the last metric I used was the price to book, which I weighted 15% in my analysis, and I was able to get a peer multiple of 4.3, and it resulted in a $17.62 intrinsic value. And by weighting that about 55, 30, 15, and I weighted the Black-Scholes model 15% for the call options and 50% for the put options. I got the final price of $13.85. And for my peers, I used Lemonade, Progressive, Renaissance-Sear, Marsh McLennan, and Allstate. I thought these were the best peers for the company. Lemonade is a tech stock that's growing really quickly as well. And Progressive and Allstate are obviously two of the biggest players within the auto insurance industry. And Renaissance-Sear and Marsh McLennan, they're reinsurance companies that are growing very high as well. And I thought they were good peers. So on this slide, I've listed the management team for Root Incorporated. Just to touch briefly on a couple of names. The CEO is Alex Tim, and he's the CEO and co-founder of Root. And prior to Root, he worked at Nationwide Insurance as a consultant, and he has a lot of experience within insurance as well. So he does come from an insurance background, which is good. And the CFO of Root is Daniel Rosenthal, and he was appointed in 2019 actually, and he's been a board member since 2017. So he's been around with the company for a while. And prior to Root, he worked at companies like Pelotonia and the Milestone Aviation Group. So not necessarily a insurance background, but he does have, a background with, good companies. And the CTO is Dan Manges, and he's also co-founder of Root. And prior to Root, he actually worked as a CTO for Braintree, which is a fintech out of I believe Chicago. So it's a very strong management team. And if anything, if you look at this, we should look at it as positive.